YouTube, what's good? It's No Limits. Today we're going to be reacting to arguably one of the greatest psychology videos of all time. This video alone has changed my trading career, and it's a video I highly recommend. So I'm going to put y'all on game to watch this video. If you're somebody who's struggling with that pillar of your trading, this is definitely a recommend. I guarantee you, you're going to leave with some type of gold nuggets and some type of knowledge after watching it. So please pay attention. Let's get it. We're going to be reacting to Mark Douglas, one of the greatest psychology coaches of all time. Let's get right into it.
Correlation between what the trader ends up with and what he could have had if he just followed his methodology. In your DVD program, you refer to this as the profit gap. This is a problem. You refer to it as the profit gap. And I think it's one of the least understood concepts of trading. Can you address this a little bit, this profit gap?
Yeah, that's actually a really good place to start because I think that more than anything, what your viewers want or what your customers want are consistent results. They want to be able to produce an income that that they can rely on from their trading. And I'm sure that many of your viewers have already realized that getting a steady income is not such an easy task.
Yeah, and everyone seems to get trapped thinking that because trading is easy.
Right.
Or because it's easy to find yourself in a winning trade,
Exactly.
which many people do.
Right.
That they think it's also easy to become a consistent winner.
Right.
And it took a long time before it actually dawned on me that winning and being a consistent winner are two completely different animals, two different things. And in some ways, there isn't even a relationship. So
Being a winner and being a consistent winner is two completely different things, man. That's a fact. You know what I'm saying? You could probably win trades here and there. You might hit that home run trade every once in a while, but it don't mean nothing if you can't be consistent, bro.
between the two.
It almost seems like there's no relationship between the two.
Yeah.
That's what you're saying, right?
Yeah.
Yeah, that's a real hard mental barrier to break through. Mainly because, it's so easy to find yourself in a winning trade because winning actually requires no skill at all. In other words, unless you consider that the being able to click a mouse button or tap a pad is a skill, right. And we don't have to have a reason or good reason or even actually any reason to put your cursor on the buy or sell button and then immediately find ourselves in a winning trade. And it could be a monster of a winning trade. And what did it take? What kind of what kind of skills did it take to actually experience this? Absolutely no.
That's a fact. It doesn't take skill to win a trade, right? To win one trade, anybody can look at the chart, place buy, get lucky, and win a trade. That takes no skill. We've all been beginners. We've all gotten lucky when we first started our trading careers and probably won a decent amount of money off some luck. You feel me? But you know what does take skill? To win consistently, to do it over and over and over and over again. Keep cooking up. Keep listening.
Yeah, so it'd be natural to take the leap from, well, if it's this easy to win, it can't be that much harder to make a steady income. Like you said, it's that easy to click the mouse. For me to sit there and make $5,000 or $10,000, then it must be pretty darn easy for me to sit there and make a living out of this. And that's what I thought for a long time, but that is not the case.
No, and that's exactly how I started out too. And I know, not unlike a lot of other people who are willing to, let's say, give up a real high-paying career to be a trader because they thought it couldn't be that hard.
So what makes consistency so challenging?
Trading ain't easy, bro.
Hurdle?
Don't think this shit's sweet.
We're gonna get into that, but at the most general level, I'm gonna say that it requires learning the type of skills that people just simply aren't used to learning.
Mental skills.
Mental skills, yeah, exactly. In other words, it requires mental skills. Most people assume that because their technical method gives them a signal to get into a trade, that if the method produces a high percentage of winners, it will equate to a consistent income, not taking into consideration that the proper execution of those signals requires mental skills.
Give us an example of this.
Well, take for an example, a high school basketball player who, he'll go in the gym and practice throwing his free throws, maybe for even 2 or 3 hours a day. It wouldn't be unusual for him to be able to hit 50 in a row, would it? I mean, that's
you
not
see that all the
out of
time.
the realm of reality, right? Okay, so the problem is that could he even hit 2 in a row if the circumstances were he was in the final game of the NCAA championship, his team is down 1 point, there's only a few seconds left on the clock, and he was just fouled. Yeah, under those circumstances, without the appropriate mental skills, hitting either one of those free throws is very unlikely. And regardless of how well someone...
Yeah, He's spitting right now, bro. He's spitting. When we back testing, when we trading on demo, it be sweet. We can go on winning streaks. But when we in the live market, when your money is on the line, it gets harder. You start feeling the pressure. We are attached to money as human beings, right? The way to be successful from trading is to detach yourself from the money and just focus on what you're actually doing. Leave the money out of it. So that's what he's saying. It becomes harder to perform once you have that attachment and that pressure gets onto you.
Could do it in practice. Most people would choke.
So really the skills you're referring to, what you're talking about, Mark, is actually staying focused on the process, staying positively focused on the process itself, in this case, of throwing the ball, in our case, obviously, of trading or following your method,
Right.
and not being worried about blowing it, about the consequences of what could happen if this trade goes wrong.
Exactly right. Just like what I'm going through right now.
Here
Trying
on
to stay
TV.
focused, yeah. Trying
You
to
gotta
stay
be
focused on the process
process-driven,
of this
guys.
presentation and not blowing it.
Process driven. Focus on the process, not the results. If you focus
Anyway.
wholeheartedly on the process with
You
all
know,
your
with training,
attention,
we may have a
the
technical
results gonna
method
come,
telling
bro.
us what to do and giving us the potential to generate consistent results. But like the basketball player, without developing the appropriate mental skills, it's unlikely we'll be able to do what our method, our trading plan is indicating.
Trading is a mental sport, bro. It's a mental sport, like dead ass. You got to develop these mental skills to stop yourself from stepping in your own way.
Without making a number of potential execution errors. In other words, to stay positively focused on the process of trading by doing exactly what we need to do, when we need to do it, without hesitation, reservation, or fear.
Okay. That's
So
interesting.
you see, no matter how good a technical method is at generating winning trades, turning those winners into a consistent income requires the ability to do or not do some things that the method itself can't help us with. For example, our method can't force us to predefine the risk of getting into a trade. Or if we do predefine the risk, our method can't force us to take the loss that ends up turning into a bigger loss.
Right.
And you know, that's happened to everybody. Okay? Our method can't prevent us from moving a stop closer to our entry point where we get stopped out and the market trades back in our favor. Our method can't prevent us from hesitating and getting in too late. Or our method can't
Your trading edge, your trading strategy cannot prevent the things he's saying, bro. That's a difference. You have your edge, right? You have your strategy where you enter and exit the market, but that cannot help you prevent the mental everything he's talking about is the mental frameworks of trading.
stop us from jumping the gun and getting in too soon, where the signal to actually get in never really develops. And our method can't stop us from getting out of a winning trade too soon and leave money on the table. Nor can it prevent us from letting a winning trade turn into a losing trade without having taken any profit.
I know that all of our traders have experienced these issues. I know they have, and I think really what you're saying is that the methodology, and this methodology, folks, what we're talking about when we say the word methodology is the Wise Trade software, that's our method. And it can give us winning trades. We've seen, I know all of you have had winning trades, but it cannot give us consistent results if we're susceptible to making the kind of mental errors that you're talking about here. Okay?
Exactly right. Yeah, that's exactly what I'm saying. And all the mental errors I just listed are the result of thinking, a result of thinking, believing, or assuming that our technical method is telling us what's going to happen next on a trade-by-trade basis. And not understanding that technical methods aren't designed to do that. Technical methods and patterns are designed to put the odds of success in our favor over a series of trades. It may not seem like it on the surface, but there's some profound psychological implications here. What this means is the outcome of the signals generated by any technical method on a trade-by-trade basis are unique and random. In other words, there's no...
It's a probability. Your technical edge, just because you might be taking one of your A-plus setups, right? One of your very best setups that is in your strategy, your technical edge. You have to remember it's still a probability. Just because your edge is in the market does not mean it's going to play out every single time. That's literally what he's saying.
To know in advance what the outcome to any particular signal will be or what the sequence of wins or losses will be over a series of trades.
It's a mouthful. and I understand what you're saying. And I think, you know, we need to, first of all, know that many of our viewers out there are experiencing the same sort of thing, okay? and they're probably going to have some trouble grasping this concept that by accepting the randomness of these outcomes, they can produce consistent results. That's an odd concept.
Yeah, but that's exactly what I'm saying, Jared. I know it's somewhat of a paradox to think that events that have a random outcome can produce a consistent result, but think about it. This is the principle that's been used by casinos for hundreds of years.
Right.
Technical methods and patterns will give the individual trader the same kind of advantage the casino has over the individual player, if the trader can think about it from the proper perspective. On the other hand, if a trader who has generated his signal from a technical method hasn't learned to integrate this principle, this randomness principle, into his trading regimen, he will undoubtedly find that trading can be one of the most frustrating, if not exasperating, endeavors he's ever chosen to undertake.
Almost
And I know there are a lot of viewers out there who may be experiencing frustration. In fact, I know there are definitely viewers who are experiencing frustration, but I'm not sure if they're making the connection that the reason because they don't believe in this randomness principle where you can generate consistent returns by looking at the outcomes of their trades as random and unique. Right. They have to be able to view that as random and unique. That's, I think, the big issue.
No, I know, and that's why we're here explaining it right now. You see, the frustration comes from our expectations. It's from expecting something from our technical method it just can't do. Technical methods define and identify patterns in collective human behavior. Right. Now, the patterns definitely exist. They repeat themselves over and over again. The problem is the outcomes don't always correspond with the patterns on a trade-by-trade basis. So what I'm saying is that, yes, we have patterns, yes, and they repeat themselves over and over, and our minds just naturally think, well, I have a pattern that's consistent, I should have an outcome that's consistent with the pattern, right. and that's not what I'm saying at all. What I'm saying is that there doesn't have to be a relationship between the outcome and the pattern.
Right. So, and if the last trade was a winner, right. This trade, even if the charts are the same, right. Even if we've got the same exact signal, the same...
He's saying it's random, bro. He's saying that it's random. That what he's trying to do is to think of a probability mindset more so instead of believing in okay, the market's doing this, right? This means that this has to happen. There are a lot of unknown factors that occur in the market, right? It's literally a fluctuation of money, bro. You don't understand how many things actually impact the way financial markets move. You got banks, you got hedge funds, you got wars, you got inflation, you got deflation, you got, all different type of factors, bro, that can affect the market at any given point. I know y'all remember during quarantine, well, y'all probably don't remember, but during quarantine, Donald Trump literally tweeted something that made the stock market just go crazy off of a tweet. You get what I'm saying? He's saying your trading is going to be random, but you can still make money. You have to accept that. You know what I'm saying? Not everything is guaranteed in here.
Looking chart, there's no guarantee that this trade is going to be the exact same as the past one.
Exactly. In other words, this trade, the trade I'm in right now, could turn out to be a winner. And does that mean that the next trade's going to be a winner? Absolutely not. This trade I'm in right now could end up being a loser. And does that mean that the next trade is going to be a loser? No, absolutely not.
Yeah. This is interesting. I mean, I'm trying to, for us up here, the goal, the main goal is obviously to take these concepts and reduce them down to the most simple of terms. So, let's again back up here for a second. There are traders out there using WiseTrade every single day. They're getting the same exact patterns, okay? But what you're saying is even though the specific criteria is being used to identify the pattern, okay, for each signal, same criteria, same formula, same everything.
Right. The chart pattern can look exactly the same. Everything.
Right. The outcomes to each signal have no relationship to one another.
That's right. That's exactly what I'm saying. That there's a random distribution between wins and losses over any sequence of trades that you might look at. And so, and again, this is a very difficult concept to grasp, but it's really the traders who have grasped it, let's say, and learn how to think in what I call probabilities. Okay. They're the ones that don't experience the same kind of emotional trauma that the typical trader does because they're expecting something that just may not happen. So for an example, if this trade's a winner based on this particular trade I'm in right now, based on the exact same criteria that, you know, or let's say I'm in a trade right now, or I'm getting into a trade right now, and the exact same criteria exists in the market that did the last time, I'm going to naturally expect it to be a winner if it was a winner the last time. Or I probably will naturally expect it to be a loser if it was a loser maybe the last time, or we had 2 or 3 losers in a row.
And this could be a source of frustration for traders.
Oh, absolutely. In other words, and that's exactly what happens. It is a source of frustration, because if I'm expecting it to be a winner and it turns out to be a loser, I'm going to be frustrated. Not only going to be frustrated, I'm going to be disappointed, and I may even feel betrayed, depending on how much kind of energy that I put into the idea that the trade is going to be right.
Well, how do we get over that? I mean, how does a trader take, okay, so I've done all the things right. I've got my charts lined up. I've done everything I was supposed to do. How does the trader at least begin to accept these sorts of things, or how do they begin to remedy these issues?
Well, here we kind of have to get into the nuts and bolts of this, of just exactly how the markets work, because I think that one of the big problems, one of the reasons why people have such a difficult time with this, is because their initial exposure to the markets themselves is through electronics.
Right.
In other words, through electronics, there's a real disconnect between what you're actually participating in and what's causing you to want to participate in the first place. In other words, markets started as exchanges. Right. And so when you traded at an exchange, so you know that all prices are people-generated events.
Correct.
They are, and see, this is what people have to take into consideration. Everything happens because of what people believe.
All right, so the concept he's trying to say is basically there's 2 different perspectives and kind of like realities in trading, right? Because of how technology has advanced, it's allowed everyday people like me and you to just literally pick up our cell phones and trade into a financial market. It didn't always used to be like that. It didn't always used to be this mobile to where everybody had access to. You used to have to be able to be a part of a trading floor or something like that, and the feel and the professionalism and the everything about trading was just way different. You dressed up in a nice suit, you went to the office, there was a trading floor with a bunch of different traders, and these guys were professionals trading at a hedge fund, at a bank, at trading big money. It's just a whole different vibe to trading nowadays, to where we don't fully understand what it actually is, because we don't know the ins and outs. We don't always have the proper education, because we literally pick up our phone and seen it on YouTube. This is what I'm saying. The OGs have it's a very big difference.
You look at the nature of trading and break it down to its simplest components, what you have is everyone trying to do the same thing. There is no possible way that any of us can make money as traders unless we can buy low and sell high, or sell high and buy low.
Correct.
Is there any other way, Jared?
No.
No other way?
In every market.
In every market. So basically, everyone's trying to do the same thing, are they not?
Yes.
Everyone is doing the same things. Now, the reason why we have price movement is because everyone has a different idea about what is high and what is low. Okay?
Right.
So now I get exposed to a technical method. Now, what does this technical method do? And this is the relationship that people need to grasp. If they grasp this relationship, then they can grasp this idea that you can take the same set of criteria and end up with random results. And it's this. It's like what people realized years ago is that you can take data points. In other words, data points meaning what you're doing is you're translating the human behavior, the human belief in if I'm going to buy
into something visual.
What's that? No, it doesn't have to be visual, but it's like it could be. Yeah, it started out being visual. It started out being chart patterns based on bar charts. But what you do is that if I'm going to buy, it's because right now, let's say the last price is 10, and I put in an order to buy something at 10, okay? It's because I believe that the market's going to go to 11, correct, or it's going to go to 12. Right. Certainly if I thought or I believed it was going to go to 9, I would wait, would I not?
Correct.
So the reason why I'm buying at 10 is because that's what I believe. In other words, all price movement is based on people's belief about what's going to happen in the future.
Now you said to me in a conversation we had yesterday,
the market moves based upon where people are buying and selling at, off of supply and demand, basically. The market is moving based on the ideas of people. So if everybody thinks that at the key level of 1.00, if everybody's buying at that point because they think the market is going to go to 15, right? That's going to cause the market to go up. That's what he's saying, bro. Like this shit is really like a lot simpler than what you think.
Obviously, we as individual traders are not large enough in our accounts to move the market.
Exactly. And
Okay.
so this is the next connection that people have to make, is that since all price movement is based on people's conviction or belief about the future, how do prices actually move? For an example, when you put in an order or I put in an order, I don't trade at a level where I can actually move prices. But what the typical screen-based trader doesn't understand is that there are traders, there are thousands of traders out there who do move prices, and that it is their intention to move prices. Or you can have a large group of traders coming into the market and then cause prices to move. But what actually has to happen for prices to move is this, is that if the last price of something is 10, for the market to actually move to 11, all the offers have to be taken out, meaning that, or move to 12, all the offers at 11 have to be taken out. So in other words, people who are trying to sell at 11, they have to get their orders filled before it can get to 12. Right. Well, for someone to actually bid it to 11 or bid it to 12, they are doing the exact opposite, and this is really critical. They are doing the exact opposite in that moment of what it takes to be successful. Okay. They're not buying low, they're buying high. They're buying high relative to the last price, or buying higher relative to the last price.
So how does understanding this concept, how does understanding...
He's literally telling you how the market moves in the most simplistic way possible. The market moves off of people's ideas of where they think the market's going to go. Simple as that.
What moves the markets help our traders to take it to the next level? How does, I mean, is this the first step for them getting control and understanding how the markets work and getting a grasp?
Yeah, they definitely have to understand. They have to understand how prices move, because when they understand how prices move, then they'll understand how their technical method relates to this movement. Because what technical methods do, whether it's a visual pattern or moving averages or any wise trade or whatever, you're using mathematical formulas. Okay? You're taking data points. In other words, you're taking what people believe about the future, transforming them or transposing them into a data point. As a price over time, okay, or with volume. There's any
or a
number.
Fresh cross.
Yeah, there's any number. That's what it ends up being, as a fresh cross. But I'm talking about the actual mathematical formula that makes the fresh cross. Okay. So there are any number of variables that go into this equation. Now, what people have found is that, and this is here, what people have found is that using these data points into certain types of mathematical equations, you can find patterns in collective human behavior. And what these patterns mean is this: is that when this set of criteria, okay, is present in the market, that there is simply a higher probability than not. In other words, there's a higher probability, or what I'm going to call an edge, a higher probability of one thing happening over another, that other people are actually going to come into the market and bid it higher from here or offer it lower from here. There's just, in other words, when the pattern is present, this collective pattern is present, it will repeat itself. But the problem is that it repeats itself on a random basis, because even though the actual mathematical criteria is exactly correct or exactly the same.
Mathematical models can't predict human beings.
That's right. Mathematical models can't predict who the actual individuals who are going to come into the market and actually do it. In other words, it takes someone to do it. When you put on a trade, if you're not going to make your trade a winner by bidding the market, if you bought something by bidding the market,
using all of my money.
Using all of your money if you bought something at 10, you could actually wipe out all the offers and bid it to 11 or bid it to 12 or bid it to 13. Now, if the price is at 13, all the trades that you put on at 10 are winners, right?
Yeah, but I still bought it at 11 and 12.
Yeah, but you're averaging up. But the point is, all the trades that you put on were winners. You actually made yourself a winner.
That's correct.
But what I'm saying is that when you don't trade at that level, we are actually obliged to other traders to come in to buy something at a worse price than what we thought was low to make us winners.
So what you're saying is most of us out there are dependent upon someone else to move the market for us. We're trying to identify that pattern, obviously using the Wise Trade software to find those common entries. But again, it's a random event. Well, we're putting the edge, you said, in our favor.
Yeah. Jared, when you put on a trade, okay, when you put on a trade, do you know who, now what we've done, we've reduced the market down to these terms, okay, that it takes someone else to make us a winner, right?
Correct.
Okay, when you put on a trade, do you think about who that might be, who might come into the market to actually make you a winner?
No, of course not.
Yeah, no. And if it turns out to be a winning trade, do you know who those traders were or who that trader was that actually made you a winner?
No.
Is there any way to know?
No.
There might be, but it'd be pretty hard to find out, right? I mean, you could
Make
go,
up your phone
you could go,
calls.
yeah. Well, you can go to the clearing firm, you know, the firm that clears the
bottom line is you
bottom line. Yeah, exactly. So what I'm saying is that when the pattern presents itself, like, okay, I have an edge here. When the pattern presents itself, we don't have any idea of who is actually going to come into the market to do this for us. And so there's no point in analyzing. There's no point in judging. There's no point in trying to figure out whether it's going to work or not. It would be like, for an example, if I said to you, Jared, I'm going to give you a coin, and this coin is weighted in a way where it's going to come up heads 70% of the time. Right. Now, just because I know mathematically and statistically that this pattern of coming up heads 70% of the time exists, is there still any way for me to know the actual sequence to heads to tails?
Of course not. It's an infinite.
Well, no, I'm saying, do I know the sequence? In other words, I'm going to flip the coin 100 times.
So what he's saying is, let's say you have a 50% win rate, right, in trading. You don't know what 50% of those trades are actually going to be wins. So your 50% win rate strategy you might take 10 L's in a row, right? But that's the thing. You don't know when the wins are going to come or when the losses are going to come. You could take win, loss, win, loss, win, loss. But all you know is you win 50% of the time. So you don't know what sequence your wins and losses are going to come at. That's basically what he's saying.
And statistically, it's going to come up heads 70% of the times. I still don't know which
times
flips are going to
heads.
Which flips are going to come up
Just
heads.
like when you flip a coin.
It's not the times. Right. Which ones? In other words, we flip the coin.
You know you have a 50-50 probability when you flip a coin if it's going to be heads or tails, right? So basically, you can flip that coin, let's say 10 times, and you might get heads all 10 times. Now, that's highly unlikely, but you feel me? Your probability was 50%. It can happen.
Once, it comes up heads. Flip the coin twice, it comes up heads. The next one's tails, the next one's tails, the next one's tails. In other words, we could have streaks of heads or tails, okay? We could have streaks in there. The point that I'm making is that there's no way to know the actual sequence.
But at the end of the day, we know we have
70%. So what that does, that obligates us, if we want to be able to trade our methodology in an effective fashion, to be able to utilize this methodology in a way where we can extract the maximum amount of profit that it makes available to us based on the pattern that it identifies. We have to do it in certain ways. In other words, our mind has to be free to be able to execute these trades without making trading errors. And the trading errors come from believing that because the pattern is present, that it's going to give me a winning trade on this one. This trade is going.
Bro, he just cooked. He just cooked. Your problems, your psychology problems come into. Actually, I'm gonna replay that one more time for y'all.
Be a winner.
You can't think that way.
No, you can't think that way.
You can't think that
That's the way the typical trader thinks.
Right.
The typical trader thinks, I'm not going to put this trade on unless I think it's going to be a winner. Or why would I do it? And it skews our expectations. See, it messes our expectations.
Let's back up a couple seconds here. There's some great stuff here, Mark, and I hope our traders are getting all of this. You're basically saying, this makes a whole lot of sense to me, and I hope it's getting through to you guys. We have a tool that gives us an edge, whatever it is. Right. Even if that edge is 2% or 3%, I don't know if we can.
No, it's more than that.
Maybe more than that.
What do you mean more than that? It's a lot more than that. It's far more than 50%.
Well, I was saying greater than 50. Okay. I was using edge is defined as,
okay.
So maybe 55 or 56%.
Is that there's no way to know the actual sequence.
But at the end of the day, we know we have
70%. So what that does, that obligates us, if we want to be able to trade our methodology in an effective fashion, to be able to utilize this methodology in a way where we can extract the maximum amount of profit that it makes available to us based on the pattern that it identifies. We have to do it in certain ways. In other words, our mind has to be free to be able to execute these trades without making trading errors. And the trading errors come from believing that because the pattern is present, that it's going to give me a winning trade on this one. This trade is going to be a winner.
You can't think that.
Your trading errors come from when your edge, or aka your pattern, your strategy, whatever you want to call it, comes into the market, you believe that that specific time is always going to be a winner, which is why you probably over leverage. You probably overtrade. You might take your stop loss off. You might, do things like that. You might enter multiple positions, right? It's because your mind, you've convinced yourself that, okay, this is your setup that you like to trade. This has to be a winner, right? You this is where your errors come from. Literally, that's literally what he's saying.
So people can realize too that depending on what the ratio is between what you have to risk to find out if a trade is going to work and how much profit it generates when it does, you don't even need a 50% win-loss ratio. Right. As a matter of fact, back in the 80s, there are, one of the most famous traders from the 80s, Richard Dennis, on a percentage basis, 95% of his trades were losers. 95%. But the 5% that were winners were monsters. And he was able to take, he was able to put on.
He just said one of the greatest traders back in the day. Man probably made millions. He said he had a loss ratio of 95%. He lost 95% of his trades. But on those 5% of trades that he won, he said they were monsters. Big ass, bro. That's insane. That is absolutely insane. I don't have the type of right mindset to lose 95% of the time. Like that would really like hurt my confidence. Like I'm a more of a high win rate trader. I need to win majority of the time. I don't see how people. It takes great psychology to be like a trader who only wins 30%, but your risk to reward is just so good that it evens out to being profitable. I couldn't do that. I need a high win rate.
Trades at a 95% loss ratio and make at the most at one point, I think around 1987 or 1988,
now,
he had $400 million.
Is that using his edge
$400 million
or his money management, or a combination
of all of it?
Okay.
And see,
losing 95% of the time, $400 million.
To qualify with, he would use orders to actually probe the market. See, there's one of the things I don't want to leave what we're doing right now, but I'm going to just kind of divert just for a moment, okay, and so that people understand that one of the first things to be a successful trader that you have to learn, other than the fact of finding a good edge, meaning something that puts a pattern, a collective pattern that your edge identifies, that puts the odds in your favor, right, that there's a higher probability of one thing happening over another once this pattern is present in the market, is that you have to learn how to think in probabilities. In other words, you have to get your expectations
mindset,
aligned
bro,
with the way the market actually exists. Right. And when you do, in other words, when you learn these kind of mental skills and you're able to execute your trades without fear and without hesitation, without analyzing, or even without thinking for that matter, because you don't need to think. I'll give you an example. A professional trader, what a professional trader thinks about when there's an edge present is, does he think about whether the edge is going to work? Absolutely not. Because he knows he has learned there's no point.
Right. Professional traders don't question whether their trade is going to work or not. He said that doesn't even come across their mind. That's crazy, bro. That's all I do when I'm in the trade. I'm like, bro, is this gonna work, bro? Is this trade gonna work? I'm nervous, bro. I don't know. Like, you feel me? You know what I'm saying?
No point in analyzing or judging or building a case for or against whether that trade is going to work, because he understands the human component. Okay. But what he does think about is he thinks about the risk. How much do I have to risk? How far am I going to let?
That's the only thing you control. That's the only thing you control is your risk, how much money you put on the line. That's the only thing you can control in your trading is your risk. How much money, you can't even control how much money you're going to make. You can control how much money you're going to risk, though, how much money you can lose. That's the only thing. Everything else is random. You feel me?
Market go against this position to tell me that other traders are either going to come into the market and make me a winner or not. And he also has a plan for how he's going to take profits.
Right.
But the typical trader, what does the typical trader do?
They don't have a plan. Or they think about the trade too much. They think about, is this going to be a winner? Is this going to be a loser for me?
The exact opposite of the professional.
So what the professional does is basically...
And then once they make up their mind that it's a winning trade, they don't predefine their risk, do they?
Right.
And they also don't have a plan to take profits because they think when
it's going to be a winner.
It's going to go on forever.
And I want to talk about that. We're running up on the break here, but I want to talk about that on the other side. But what you're saying is the bottom line is the professional sees the entry. He sees the pattern, whatever it is, the edge, enters in, not thinking if I'm going to win or I'm going to lose, but has a money management strategy in place, knows exactly how much he wants to win or is willing to win and how much he's willing to lose or risk Right.
Exactly.
Now, does he put a cap on the upside? Does he put a cap on his win
Well,
side?
it's not a matter
Or a
of
goal?
a cap. It's a matter of how, his assessment of how much potential there is. Okay. In other words, see, the problem is on a winning trade, we're obligated in a sense to make these never-ending decisions as to what the risk to reward ratio is. In other words, as the market's going in my favor, what's the risk of finding out that it's going to go further? And that's why so many professional traders or people who teach trading advocate scaling out of positions.
Right. Mark, this is all great stuff. We're going to have to wind it up. We got to go to a break, guys. It's already time, as I said, for a break. We'll be back with much more with Mark.
All right, so this is half the video. I'm gonna make this 2 separate videos. I know most of y'all got TikTok brain and y'all brains are fried from shorts and reels and TikToks, and I know y'all can't sit down and watch long-term content. So I'm gonna break this up into 2 videos for y'all. It's another 25 minutes left. And if you guys learned something from this video, if you guys, had something that he said that stuck with you, put it down in the comments, man. Please leave a comment on there, leave a like. Don't forget to subscribe. And I'm out. See you in part 2.
762, man, we blasting his whip. Whole lot of blood had to down me a crib. He say he can't breathe cause he tagging his ribs. Caught him outside with